you add a dollar to the net operating income, it's going to come back. Could be 5, 6, 7, multiple of dollars on the value of the properties, and that's the math behind the double dip.
Welcome into the Get Invested podcast, a podcast about all things real estate and real estate investing, brought to you by Capital Velocity Investments and a part of the Matthias Talks Investing Substack. Hello. Welcome into another episode of the Get Invested podcast with your host, Jordan and Matthias. We're, as always, excited to be here to talk all things investing, real estate, and real estate investing. Today, we're going to talk about the good kind of double dip. I guess we're dating ourselves, but for most people listening, I think they're right there with us as far as the Seinfeld reference goes. You know, brief tangent before we jump in. MythBusters proof there's like very little germ problems with double dipping a chip.
That's good news because I have for an entire life ignored that rule.
Yeah.
Whether people are watching or not, I'm really just listen. I need a little bit more ranch.
Yeah. So
or salsa or whatever.
Yeah, exactly. I was going to say it was a quintessential George Costanza thing of making a lot of nothing, but actually he was the one who gets accused of it. It's like the relative of his girlfriend who's mad at him about doing it. So anyways, all right, well, we're going to talk about the good type of double dip that's involved in real estate investing and value add strategy here in a minute. But before we do that, this is the first time we've potted since you guys went off and I guess did a lap in the Caribbean and came back on a big boat. So how was that? How are things?
It was good. It was a week-long cruise with Chen's family. So we had grandparents and sister, cousins, and everything. So good time. We'd never been to Aruba and Curacao before, so that was cool. Super Bowl happened while we were on board. We got the guys all kind of gathered on the back of the ship to watch that. Went exactly as I expected it to. The game anyway, but the rest of the trip was good. I mean, we got to see a little bit of stuff we'd never seen before, some adventures, some just hanging out with family that we don't get to see too much. So it was a good time. We got a little under the weather by the end of the trip. The youngest, Aaron, had a little bit of a fever the last couple of nights, but he's back to normal now. He passed it on to me, so I've been a little bit sick this week. I was able to enjoy the whole time on the ship, but this week I was under the weather. But back at it now.
Caring. Thanks, Aaron.
Yeah, exactly. He's always generous with his germs. So
double dipper or no?
Exactly. But it was a good trip, a lot of fun. Glad to be back after it. Kind of, it always feels weird to take time off. You feel like you're missing so much. But like I was able to stay off my phone and email and stuff for almost all of the trip, so that was nice. It's nice to be able to cut loose, and turn your brain off because there's always going to be the worry. But not bad. Can't complain.
Yeah, that worry of what's happening while you're gone, definitely partly a control. I remember when I was teaching, I was the worst at that. I would never take days off unless I was like deathly ill because I'm like, I don't want to come back to whatever happened while the sub was there and they didn't learn. Like it really would have made like 1 or 2 days, like really made some vast difference. But it's hard for a lot of teachers to take time off during the year. They just, for that same reason, they just don't want to.
Yeah. We're doing stuff.
If we're doing stuff, I'm leaving it to someone else. You're in my space. I mean, if you're working, there's a lot of jobs where if you're gone for a day or whatever, it's, your desk was exactly as you left it.
Yeah.
You may have more emails. That's about it. But anywho, the update on this side is Rachel had that major surgery. And pretty much what we've been doing is just making sure she recovers. She doesn't have basically a right arm, or she very much didn't have one for like 3-4 days where she couldn't really do anything. But I mean, she's now at the point where she can kind of like one-armed get dressed and showered. And
is she doing any PT yet? Has she started that?
Yeah, 2 times a week. Yeah. So we're driving over to Matthews for that. She's been home from work. This is the last day. She goes back Monday. I'll be driving her many of those days to work. So I'll be getting up and driving her to work at 5:30 in the morning. Yeah. And then, so a lot more PT left, a lot more of that. And then a lot of different kinds of exercises to get that mobility back. But that is the big thing that's been going on around here. earlier today, I just tell you this is just so random. And so non-adult, that doesn't sound right. That's kind of how I think about it. But we walked downtown real quick we went for a walk because that's all she can do to exercise, right? So we went for a walk and we can walk downtown to Pineville and to get coffee there and then walk back. Well, it kind of looked cloudy when we were leaving. And I was like, ooh, it's going to rain. Let's do it. And it's about a 15-ish minute walk. So we get there, we're sitting there, we're having our coffee or whatever, and we start looking outside, and Rachel's like, "Ooh, it's blowing, like whatever. Let's go. We might want to try to beat this rain." In retrospect, we should have just sat there and waited for the rain to happen. But yeah, So we were too far away to go run back, and she can't run anyways, right? But like not close to anything. Finally, we found like there's a public meeting hall place that we could huddle under. But yeah, so we just like got soaked walking through the rain, and I was just trying to think about the last time, like as an adult, I just got
did that poorly
walking in the rain. Yeah, just got soaked because I guess poor planning and just in general, like, oh, I guess I'm just now very wet. Luckily we were in like walking clothes and we just walked home and took them off and took showers, but I just it's just not something that happens in a normal day-to-day adult life.
No, because you either bring like an umbrella with you if you plan to be out and it could be rainy, or you're in your car and you just run to your car and get in your car.
Yeah, exactly.
That's funny.
Yeah. So we had to like literally go and like stand on a porch, I don't know, a solid 10 minutes just waiting for it to like die down some because it was pouring.
Yep.
Anyhow, so that was kind of fun. That was funny. Random thing.
It
rained for about 25 minutes today and we were out in about half of that. Yep. Mm-hmm.
Yep.
I mean, that's usually not the percentage that people go for.
Oh, that's funny.
All right.
Yeah.
Yeah. We're in a neighborhood and this is what's happening. All right, well, let's jump in here and talk about the double dip of real estate investing. This is something that was a newsletter like a year ago, and I felt it's something that we've definitely touched on it in some form or fashion, but it's one of those that, again, that we've just never, I don't think, on air gone through very deliberately and specifically, and I'm excited to just kind of talk it through. Math may be done on the fly on air, so everybody prepare themselves for that. We even have a cheat sheet over here of the newsletter, but that doesn't guarantee anything. No. But before we jump into that, we're probably going to go back just a little bit and give a recap on how apartment buildings and properties are valued, or the valuation process. And so I'm going to turn it over to you to get us started with that.
Yeah. So when we talk about, this is one of the fundamental reasons that we like this type of investing so much, and we think it's so effective, is the term the double dip, is because of the different ways you can earn money while operating apartments. So to kind of explain them, obviously, we'll back it up here. And so apartments are valued off of their net income. That is the most important variable that goes into the kind of the calculation of how much an apartment property is worth, an apartment building or complex or what have you. So the net income, basically, so you've got your rent and any other ancillary income minus all the expenses, the management fees or insurance, taxes, all those fees and costs, expenses. And then after that, you got your net income. And that is what investors are buying when they buy an apartment complex. You're buying that net operating income. So we're going to kind of ignore cap rates and all the other things that go into it, interest rates and all that. So basically what we're going to deal with is that NOI, that bottom line number that when you buy an apartment, you're buying that NOI. Think of it like that. So you're buying a business with that net operating income. So that is the valuation that we're going to talk about today. So obviously, if you have an ability to manipulate that income or that bottom line number independent of the market around you, that is what's going to give you wealth. That is how you build wealth and add value add. That's what we aim to do whenever we buy an apartment complex. So did that satisfy a good baseline here? Is there anything else I need to hit before we jump into the kind of what we do?
No, I don't think so. I mean, like you said, I think more understanding just it doesn't really even need numbers. It's just they spend an X amount of dollars for the income of X amount of dollars and then go from there. I mean, maybe numbers later, but I will just say the one thing is that I think this is one of the things that the average investor or the average beginning new investor, it's a I don't want to say it's a difficult concept, but it is an interestingly tough like shift in like conceptualizing. I have found it to be an interesting shift of my own to think about the fact that you're not buying a thing, right? Yes, there is a thing involved,
Mhm.
right? You're not but it's not, you're not purchasing like a building. That
Right.
is, you are purchasing an income. You are
Mhm.
purchasing a revenue stream. I think that is something that for a lot of people, especially if you start talking about all the different ways that you can get income that's not you going to work and
Right.
making it on your own. I think that's the starting to think about everything being in that regard. Like, am I purchasing something that will come back and make income? And that is like the definition of an asset. I understand, but well, actually, it's not
No, it
technically
doesn't
the
have to pay you
definition of
income.
that. It
Gold's
doesn't
an
have to be.
asset and it doesn't
Yeah,
pay you.
yeah, that's true. So I guess take that back. But I would just say that is the thing. I think a lot of that is a hurdle
Yeah.
for the new investor. Let's put it that way.
Yeah. Well, the other thing to think of, so when you buy in a stock, most of the time, say you buy your Alphabet, it doesn't really pay you while it appreciates in value. You buy a stock because you expect it to be worth more later, right? So, um, apartments don't necessarily work like that because they're valued on the income that it produces. They're not necessarily valued on the underlying value of the stock or the company. I mean, theoretically, there's an income stream associated with that stock, that company that you're buying stock in. So it gets more complicated than that road. But basically, as the retail investor, you're not necessarily buying something that you hope appreciates in value over time. You're buying an income stream when you buy an apartment complex. So that income stream, your ability to manipulate that and to increase that net operating income, that's where you make money in this business. All things being equal, you're going to make whatever that net operating income is, anyways. But if you increase, and here's where we get to the double dip. If you can increase that net operating income, not only do you get more money for what the purchase price. Let's say purchase price was X because it was producing Y net operating income. But if you add to the Y, and Y plus Z is your new net operating income, now you get to keep all that money, right? You get the Y and the Z you get to keep. So you only spent X, but now you get more money. The beauty of the double dip is that you have, as you go Y plus Z, the value of the property has gone up. It's now worth more than X because the income stream is more. People buy net operating income. So if your net operating income goes up, the value or the think of it as equity in your property goes up. So, you only bought for X, but now it's worth, I don't know, I'm running out of letters, double Y,
Yep.
double
You could go back to it is funny that your
you know.
example of stock was Alphabet, and then you
Oh,
launched
and
into
then I just
XYZ.
smooth, wasn't it? I did that on purpose for sure. So that's essentially what the double dip is that you get to keep more money during your operations. You're paying yourself more money out of the asset that you're operating. But while that's happening, because there's more money, the value of the asset is going up. And cap rates will dictate how much and all that. We don't necessarily need to get into that, but that's why we like multifamily real estate so much, is that everything we do is geared towards operating efficiently on the properties that we have. And the more efficiently and less expensive that you operate them, the more you can increase revenues and cut costs. Not only do you make more money, the more money is pumped out from the asset, but the value of the asset increases according to how much more money it produces.
Yeah. And I think, you saying that like, oh yeah, so, everyone's going to be like 1+2=3, and then 3+3=9. But, because you were
Exactly.
on both sides, right?
Yeah.
There's an extra 3 in there that's hidden. No, I think just working through all the different ways that this happens, though, I think it makes it just so much
Sure.
clearer and understand how powerful it is. Because again, we always use the example of people think, okay, I'm going to buy a house, I'm going to fix it up, I'm going to flip it, I'm going to sell it again. Well,
Mhm.
that's very much, you're not buying an income. You're buying an asset, but you're not buying an income, right? You're buying
Right.
something that can be worth more later, but not something that is going to pay you steadily. It's going to pay you in a whole
In a chunk
sum
at the end, yeah.
once you sell, right? Now, if you buy to rent, then yes, you understand that. But you also, it's a little bit more tied to how nice and the location of the house, right? Rather than, well, how well is it operated? I mean, obviously that's
Sure.
in there, but it's not as big of a drive. It's a bigger
There's
driving
less
factor.
inputs for a single family house than there is
Exactly,
for a
exactly.
business. Yeah.
So, and then on the other side, and we want to probably launch into just like the steps here after I say that, you bring up stock. It's the interesting thing is if the income on a property goes up, then the valuation goes up of that property. That is not necessarily how stocks work.
No, no, it is not. A fourth quarter beat from this company. Why did the stock tank today?
Yeah, because they
No.
decided to replace members of the board. That's very personal to me today. But anyway,
Well, or somebody stepped down.
Oh yeah, exactly. So there's also, it's gone up. The income that I'm making off of it doesn't necessarily go up.
Mm-hmm.
Right. So many other factors go into it,
100%,
including what people believe.
That is and that's which is very far outside your control. And I think that's the factor that we like so much is like, this
I know exactly where you're going.
We call it forced appreciation because I don't need anything else. I'm independent of the market. I don't need anything else to do it. If I buy a property and I know that I can increase that net operating income, I can force appreciation completely irrelevant of what's going on around me. I don't need, it doesn't matter what happens to the broader market or the broader economy. All else being equal, I can increase the value of this apartment property simply by fixing things inside the business, by increasing revenues and decreasing costs, one or the other or both. And I can raise the value of that property because again, everything is valued on that net operating income. So if I can increase the NOI, I don't need the neighborhood to get nicer. I don't need the city to expand. I don't need anything else to happen for my property to increase in value. I just need the NOI to go up. And then I've increased the value of my property. And obviously there's more variables and it's not always that simple, but forced appreciation is something that I'm gathering more control to what I can impact. I don't, whatever Apple's doing doesn't, their fourth quarter estimates and their full year estimates being decreased, lowered, and and that sinking the NASDAQ doesn't impact me like it would an individual stock.
Right.
And that's the difference is it puts more control in the hands of the investor. And that's one of the huge reasons we like it so much.
Right. Yeah. No, there's no issue. There's no instances where, for instance, a company beats expectations on earnings, but then recalibrates what they thought they were going to make next year from what they thought earlier that they were going to make next year. And what they think now is lower than what they thought they were going to make. So even though they're making more than they thought, they don't think they're going to make as much as they thought earlier. So now everyone bails.
Yeah.
you're like, what? Yeah. So those kind of things can be, if you are someone who's actually paying attention at that level, none of that stuff applies. Now, we do understand if the neighborhoods around our property went bad enough, that would be
right. Like, something burns down across the street and then, gang moves in.
It turns into a free market an open air market for drugs. Yeah, exactly. Yeah. But other than that kinds of things, like it's going to have to be something drastic, not just, and definitely not just what people believe. For instance.
And I guess that's a good opportunity to talk about like what, I talk about control is all the time I'm preaching mitigating risk or limiting the risks that we have to take. And that's, in our overall philosophy, that's what we're trying to do. That's why we buy where we buy, right? It's because I want to be able to remove a bunch of risks of, the open air drug market across the street. That's why we buy where we buy. You know what I mean? Like we buy places that's very unlikely to happen. We buy places where diverse business. So, one factory going under isn't going to crater the town and everybody has to leave, that kind of thing. We pay attention, we buy so that I can execute the business plan. I'm confident that independent of everything going on around me, I can buy a property, execute the business plan, increase that net operating income, and thereby increase the value of the property, obtaining more cash flow over the life of the investment. We try to mitigate all those risks. And the best way we know how is, again, control. Is if I'm in control, I know that, well, I'm certainly not going to start doing drugs in the parking lot, and I'm also not going to burn it down or whatever. So the more I can control, the less risk the entire operation is undertaking. If that makes sense.
Right. So I think we should just break down some of the steps maybe of how this happens, because just to tie it all together, right? So for instance, one thing that is pretty straightforward that I think everyone is going to understand, and you know what, actually, I think everyone that listens to this understands everything we say. So I don't even know why I phrased it that way.
We have a very smart audience.
Exactly. And we're not saying that we explain it great. You guys just understand it no matter how poorly we explain it. You know, the investment up front of, you know, what we call CapEx, whatever, but of renovating the property. Everyone understands, okay, you renovate the property, you make it nicer, then it should be worth more. But technically, it's actually not. Unless, and this is the kicker, those renovations, which they should, lead to you being able to raise rents because you have a nicer product to offer. So yes, you can renovate a space, and especially for like the long term, if you're like, okay, and this is going to pay off just in making the place nicer in general and fixing things. And in 5-10 years of owning it, you know, it's going to pay off no matter what, because we just needed to stabilize or whatever, like bring it to a standard. So you're going to, yes, if you make money, you pay off that investment. But more importantly, the ability to raise rents, say $200 a month, because of all the improvements to the unit, is really the end goal, not just investing in the building itself.
Right. So again, it's all back to that income stream. You know, that's why we buy the properties we buy, is because we recognize that there's a gap between what the property is currently doing, whatever that current NOI is, and what it could be doing. And we go, hey, I know how to fix that. Whatever's gone, you know, we can do, like you said, renovations, or maybe it's being managed improperly. You know, they're not marketing online. They have no online presence. So there's nobody, you can't get on Google and say, hey, I need a place to live and find this apartment complex. We like to see that, because that means that typically they're not tapping into the overall market of tenants. So more tenants equals higher rent. That's just always the case. More demand means higher rent. So if nobody knows about your property, and you know, let's say there's no signage, so just driving by on whatever road it's on, if there's no sign that people could drive by, hey, that look nice. Well, there's no sign, so I'll move on about my life. They don't know what to Google because there's no name. You know, you're
group of buildings on this road.
Yeah, like, you know, it's going to be good luck. All of those things, we regularly encounter that, and that's a real thing. So those are ways that we can increase that value, and the way we increase the value is by increasing the income, creating more demand for your units by either making them nicer, putting them in front of more people, you know, increasing your marketing or properly marketing them. Those are two of the biggest ways that we add the value of the property, because we can increase that income, increase the revenues it produces for less cost. So there's always a cost increase associated with higher rent, you know, and management fees. Certain things go up, but it doesn't go up the same amount that the revenues go up. So there's most likely going to be an increase in cost, but also we also buy properties that their costs are high. They're paying too much for insurance. They're paying, you know, what have you. There's all different ways you can cut costs, and that's another way to add value. Let's say we buy a property that the rents are at market, you know, and the units are in great shape. You can still add value to the overall property and increase your revenues by cutting a significant cost. So if you identify a way, let's say you have an insurance program, because insurance is one of the biggest costs for apartments. So let's say you find a property that they have really expensive insurance. I don't know, let's say it's $70,000 a year for this property, and you know you can get it for $35,000 a year. Okay, you buy the property, you cut costs by $35,000 a year. You've added $35,000 to that net operating income, all else being equal, and therefore you've increased the value of the property while bringing home another $35,000 a year. That's a very simplified, but cutting costs can absolutely add the same amount of value. Running more efficiently, if you've got a better, more streamlined management system, you can absolutely save a bunch of money on expenses, which we've done. We've proven that in quite a few of our properties.
Right. I would understand if there are people who hear this and say, really, there's apartments not online, or like people can't manage to just let people know that they exist. First of all, yeah, it's more widespread than any of us would believe, just because of all the different types of people out there, and the fact that honestly, as much as it's easy to find things online, it's not as easy to put it online and it be found. These are
That's
two
uh,
very different things.
there is a skill to putting things online and having people be able to see them, even if they are looking for them. Now, having
Yeah.
them see them and they're not looking for them, that's even harder.
Yeah. And then that, this is why SEO exists. So, and of course, smart people like us pay other smart people to do that for us.
Yeah, that is not a Matthias problem. That is not one that I
did
saw.
it for our website. Okay, but I'm not going to leave the properties
Yeah.
to that.
Well, I mean, that's why, our property manager partners are very
So
good at
important.
that. They
Yeah.
know exactly what they're doing, and they know exactly what people in their markets, how
Would
people
be-
search for things online.
Right,
They know
exactly.
they know what is the common, is it some places Facebook Marketplace is a great place to market because that's where everybody looks for stuff. And
Right.
you get more eyeballs there than you do on, apartments.com or
Right.
whatever.
So like local ecologies, like local internet ecology,
Right.
if you will. Yeah, exactly. I remember when I started teaching at LSU, and this was in the early 2010s, and all of my 18-year-old students had Hotmail accounts, and no one I'd ever met, like my age or below, but apparently in Louisiana, for some reason, everybody
Hotmail was it, huh?
Hotmail
Interesting.
was still a thing. Yeah. So it's very much like as much as it's the world wide web, it's also very much, Facebook Marketplace.
Sure.
There's Valentine bargains around here. Yeah, exactly. The other thing I would point out is anybody who thinks, we love the fact that if this is happening, because it is a straightforward solution. Somebody who is good at this does this thing. We don't have to. We're going to pay for their services anyways because they're managing the property. And
yeah, it's almost a free upgrade.
It's cost included, right?
Exactly.
I would say, just to think about it in a more physical way, I guess. Last time you went to the grocery store, did you wonder why what was on the end caps was on the end caps?
No.
Because usually the reason is either they want to get rid of something or someone has paid to promote something at the end.
Yeah, because you'll see that first, right?
Exactly. And it works because they keep doing it. And how many of you have bought things off the end caps recently that you weren't looking for when you went in?
Uh-huh.
So putting things in front of people's eyeballs, it sounds basic, but it's important.
Marketing 101.
Yeah. So when we talk about these things, I've always thought the phrase forced appreciation is kind of an interesting phrase, but it is because you're not waiting. I think this is the other thing we haven't yet said. You're not waiting for time and circumstance and a growing market to appreciate the property. By doing things that improve the property's operations, whether that be prettifying, upgrading, better marketing, better operations, lower cost, all of those things actually increase the value of the property.
I like to think of it like this. So houses don't appreciate, markets appreciate, right? So as the market gets better, meaning more and more people are moving there, the houses get less, there's not enough houses being built to satisfy the demand of more people moving to that market. That's what just think in general neighborhoods or houses. That's what causes appreciation. So the market appreciates and it pulls up the individual values of the houses. And so all else being equal, meaning the market's not appreciating, the forced appreciation happens when with what we're describing right now. So we don't need the market to appreciate and pull up the value of our property. Now that may be happening at the same time, which turns it into a triple dip, which is great. And we choose those markets for that reason too. But we don't need it to accomplish we don't count on it to accomplish our business plan or to provide our returns. We're going to do that independently of the market.
Right.
Now, again, we mitigate the risk of having the market tank underneath us by choosing, well-established growing markets and all that. But again, that's, think of it as us doing it independent of that big giant hand pulling up the value of all the properties in the area.
Is this hand invisible, Matthias?
It's in the room with us now.
Is it the invisible hand of the market?
There you go.
I think that's a great point, that houses don't appreciate, markets do. I think that's a really important point, honestly, for a lot of reasons, for a lot of people. The biggest case in point I would say is the fact that there's been so many people who have done great remodels to either their own living quarters or the house they're trying to flip, and they don't make back what they put into it because they really liked how that kitchen looked, but the market didn't appreciate it enough. And the market, on both senses of the word, the market did not appreciate it.
Oh no, we're getting somewhere today.
Cooking with gas. So I think that's a great point that markets appreciate. I think the flip side way of saying that is when you are purchasing value add strategy properties like we are, obviously setting aside that the market is going to be strong, but it doesn't have to get stronger, right? So we're buying places that are not doing what they should in the market as it currently exists, and improving it to that point and even exceeding it a little bit is where that margin comes in.
Yeah, that's 100%. That's a good way to, like, that's where the returns come from. When we, project XYZ returns to the investors, it's going to come from, it's not going to come from the big hand. It's not going to come from anything other than what we anticipate we can control in the market as it exists right now, hedged against getting worse. I think that's the best way I can say it. Is that's how we get our returns, is that we identify that value that can be added, and independent of what's going on around us, whether interest rates or whatever, we know, hey, I can control this with this property by fixing that marketing problem, putting up a sign, decreasing that insurance cost, whatever it may be. We can fix that problem. And again, all else being equal, we're going to create higher cash flow and a higher value in the property because of the higher cash flow.
Right. I think we should just walk through this, as a recap and get out of here, because I think we've got it covered here. One of the things I think that, I think as an investor myself is great, is that that if the amount of money that the property is making goes up, that means that you are going to get more money periodically as an investor, which is, again, not the case necessarily for a stock. Right.
True. Yep.
And then you also know, as we were saying here, because it has gone up, all things holding, you are going to be able to be a part of an exit to sell it at more than it was purchased. So you make money along the way, more money, you continue to kind of growing that money you're making. And then at the end, you're selling it for a higher valuation because of the fact that more money is being made, which that is, in a nutshell, the double dip, if you will. Right. So I think the last thing I would just jump in real quick, just so people know, like, we don't even really have to call it cap rate. We can just say, let's say investors spend $1 million on a property that makes $50,000. We're going to keep it real simple. People would not do this, but 5% is pretty low. But that's all it means, is that if a property makes that's what a cap rate means. If a property makes $50,000, that's 5% of the amount that it was purchased for, right? That's what the cap rate is. You're spending amount of money for a 5% of that value in income. If you increase that to 100,000 and you still sell it at that same rate, you sell it at 2 million. That's all that's exactly what it means. Now,
right.
People don't want to sell and not buy and sell at 5%, but that's a different story.
Yeah, so that's a good point. And we don't have to get into the specifics, but it is not a $1-for-$1. It's not like, hey, that 50,000 gets added on to your million. It's a multiple of that 50,000 gets added on to your million.
Yeah,
and that multiple depends on the market and where you're at.
Well, that's the real reason I'm talking about,
right?
Because that is the outside factors, right? There's everything we can control, but there is some variation between what the market is kind of, where the market is at with interest rates and all these other things, whether we're going to be able to sell a property and someone's willing to spend an amount that equals, the net income is 7% of that amount or 8% of that amount or 5% of that amount. Right. That's the only thing where.
Suffice it to say that, you add $1 to the net operating income, it's going to come back. Could be 5, could be 6, could be 7, could be a multiple of dollars on the value of the properties. And that's the math behind.
Right. You're multiplying. You're not adding. Every time you add $1, you're multiplying.
You multiply.
Yeah.
Right. So who's excited? I'm excited. Let's go buy something.
Yeah, exactly. I'm excited. I hope you guys are excited. It's a fundamental part of I guess it is the fundamental part of the strategy.
Yeah.
And, you can understand a little bit more about income to valuation and all the different ways that can happen. So As always, we really appreciate you guys hanging out with us, sticking with us. Of course, if you have any questions or comments, you can comment on the bottom of this on YouTube, Substack, Spotify, or Apple Podcast, or you can email either of us, Jordan or Matthias, at capitalvelocityinvestments.com, or you can go to the website, capitalvelocityinvestments.com, and hit us up through the bot. Believe me, the bot will ask you if you have a question. It doesn't wait for you to come to it.
It's true.
So all of these ways and a DM on LinkedIn and more, you can get at us and let us know what you're thinking. If you got any questions, or if you just want to get involved, want to jump in, that's a possibility too. There's links on the website, and we'll definitely shoot you there ourselves if you want to reach out. All that being said, we really appreciate you hanging out with us and listening, and we hope that you come back and do the same next week on another edition of the Get Invested podcast.
Yep.